Today we got another reminder that closing prices matter a lot more than morning prices do. As the market finished the day, or the S&P finished today up 4 points after coming off of the lows by about 40 points or so. So what does that mean? What does this pattern suggest? I'm going to break down what our expectations are with this early drop below an important support level before getting back up above. We're also going to take a look at one industry that's really been beaten up during this pullback that had a really good today. It was one of your better performing industries, and we'll look for a trade idea in there. So let's go ahead and get started. Today is Monday, December the 10th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off looking at the S&P 500 with the market forecast indicator. You can see the intermediate line is now below 50, so we went from 53 down to 43. So a bearish posture, a little concerning because of the fact that it didn't last that 1 to 3 month expected that you would expect it to last when it crosses up above 50 and gets to a decent level here. So that's a little concerning, number one, and you can see the dark pink shading again after only just a couple of days of green shading there, and we had a similar only 1 day of green shading here. Here, again, the moving average never did turn green. It did turn green with 1 day before falling right back down and turning red the very next day. So you can kind of see we had a very similar pattern here. We didn't get the dark green shading on the same day, but we had dark green shading. Here we did have dark green shading with 1 day of it being green, only to come right back down the next day. And you can see what happened to the intermediate line there. So similar patterns on both of these here. Just 1 day coming after the rise up, has some bunch of yellow days there, and then back to red. So we're not quite getting to the point where we're getting the dark green shading with the green line running on the 6-week moving average. One positive, so that's the downside here. That's the scary pattern that you see, that it didn't last that 1 to 3 days. The good sign is that the near-term line did not fall into the reversal zone, that we still have this potential divergence here with equal, at best equal lows, if not lower lows, on an intraday basis, combined with or corresponding to higher lows in the near-term line. And this current low on the near-term line, while it's been down now 3 days below 50, we got the, let's see, it'd be 4 days. So this would be the first day below 50, and then 2, 3, 4. The fourth day here, it's a little longer than normal for a bullish posture. That's why we're not bullish anymore, number one. But usually when you're bearish, you get that near-term line down into the reversal zone. And while we did get the red line down to an extreme low, which is typical when your volatility is as high as it is, it's not typical for a bearish move to not get a near-term line down into the reversal zone too. When you're bearish, you can see that near-term line gets down there after making a run from the upper half of the chart. Not the case so far right now. So you can see we had a similar pattern here when we turned bearish after being briefly bullish. Near-term line never did get in the reversal zone. Same thing here during this intermediate pullback. Near-term line never did get in the reversal zone before we bounced back up. So that's a relatively positive sign. Another positive sign too is that the last 2 days we held the low point for support on the long lower shadow. Now again, intraday prices don't matter nearly as much as closing prices, so keep that in mind. So yes, we did get to a lower low today, down to 2,600, which pretty much served to get the bears out in force, right? Those who are really bearish in the market, when we broke 2,600, that was a rallying cry, only to have it come right back up. So keep that in mind, and you can even see that long lower shadow on a weekly basis. See, there's a weekly long lower shadow over here from the week of the 29th, also holding so far. So there'd be the week of the 29th there. Now go back to the daily chart, also holding. Oops. Let's just go back here. Also, that's the week of the 29th there. Also, that low point also holding for support. So your daily long lower shadows and your weekly long lower shadows still holding on a closing basis for both. Now, granted, we are still 4 days away from this weekly candle closing, and we could. I mean, we got another long lower shadow today, whose low point is also going to act as a support level on a closing basis. So you can see when we fall, we don't get lots of long lower shadows on the way down, right? We that wouldn't be the pattern. We didn't get one on this day. We did here. We didn't get one on this day. We did here. So it's not typical to fall off a cliff with a bunch of long lower shadows. It's typical for long lower shadows to occur, as you can see, at reversal points, and we'll see if that ends up being the case. Sorry about that. If that ends up being the case again here. Look at the Dow Jones Industrial Average. And you can see again, same pattern, same long lower shadow holding above the close from a couple of days ago. Same divergence setting up on the near-term line with the bearish posture on the intermediate line. You can see how the NASDAQ Composite did today. Not as long lower shadow because it was more bullish all day long. Again, avoiding reversal zone on the near-term basis. And then finally the Russell 2000. Which has been a little bit more bearish, also closing right at the low point. The low there, 1442. We ended up closing at 1443 today. So just above the low point of that long lower shadow from a couple of days ago. And near-term line is a smidgen in the reversal zone. This has been a lot more bearish than the S&P 500, or for that matter, even the NASDAQ Composite has been. Alright, before we look at some other charts here, I wanted to remind you to subscribe to our YouTube channel. Mouse over that logo right there, the Market Scholars logo in the bottom right corner of your video. Then click that red subscribe button that pops out. Also, click the thumbs up icon down below the video. That tells me that you want me to keep doing these videos day after day. One click, really easy way to give me feedback. Also down below, scroll down to the bottom and comment on anything that stands out to you. Any questions, any comments on what we talked about or what I didn't talk about in today's video. Subscribe to our daily Market Outlook email list with multiple watch lists of overbought and oversold clusters from the market forecast indicator in the S&P 500. There's a link in the top right corner of your screen there. Click that link to subscribe. Follow me on Twitter for more content like this throughout the day, and join our Market Scholars community, or Market Outlook community, that we've created on Facebook. Also, another easy way to give us feedback and let us know that you want us to keep doing these videos is with 3 clicks here on our blog. Right below the video, you can see down below, if you click this heart, that will open up this new image where you can like tonight's Market Outlook tweet. Also, if you click on this image, that will take you to your Facebook page. You can like today's Market Outlook post there. And of course, you can like it here on our blog. Those 3 clicks will tell us again, give us the feedback that you like these videos, you got something out of them, you want us to keep doing them. Remember, you can share them across these platforms as well, even on LinkedIn for those that are in your professional circle there, or you can also email the link to people that you think would value from this type of discussion. Alright, now let's take a look back on the long-term charts. You can see again the death cross that started on the S&P last week with the decline there, came really close to the week before, and we finally got it last week. And so far, you can see that the lower shadow in the weekly chart still holding for a support level. We'll see if that ends up being the case by the time this little pullback is all said and done. Of course, you can see the Dow Jones Industrial Average looks very similar. Still no death cross there yet. There's your NASDAQ Composite also still holding that long lower shadow, 69.22. We came close, 69.38 there, and there 69.69, but still closing above 69.22 as of now. And then finally the Russell 2000, which does never did get a long lower shadow in any of these indexes here. It's looking a lot more bearish than all the rest of them. We'll see if that ends up leading to some weakness, more broader weakness into the large cap space away from the small cap stocks. Let's take a look now at the 3 green arrow charts for the S&P 500. Obviously, you have 3 red arrows. Again, what does that look like when you break out the lines on the MACD and the stochastic? You can see the MACD continues to get higher low points here on this. Similar again to what we saw here when we got progressively higher low points on the MACD. And with minor highs in between like we've gotten here on the MACD as well. Both of them getting above 0, even if the 8 and 17 day moving average only got above the 30 the one time there. Both of them, both the MACD and stochastics are below falling moving averages, so keep that in mind. We're not out of the woods yet in terms of a sell-off. Things can still continue to go down, though of course that wouldn't be expected based on what we're seeing across these different charts. Okay, and then finally look at the intraday chart here, short-term chart, and you can see how we closed back up above after gapping down and hitting that, making a return move back up to Friday's low, which also happened to be last week's low, close to last week's low. We did go down to a new low, got a lot of people trapped in here before rallying at the end of the day from 258 all the way up to 265 at one point in time today. Before a slight little pullback at the very, very end to 264.08. So closing, lower high and a lower low, but closing a lot closer to the high than the low point. Low point really early on. I remember a lot of the weakness here is with the Brexit parliamentary vote being delayed. Once the British session, the European session closed, and then U.S. stocks rallied back up above this. You can see an important level on an intraday basis right there, right around 262.5 ish from multiple touches in this spot. One thing I did want to go back to that weekly chart and pull up the Heikin-Ashi candles. You can see how bearish this week's candle is. Lots of long upper and lower shadows with small bodies the last couple of weeks, typically reversal patterns. Again, remains to be seen if that ends up being the case again this week. How small this body, the body. Remember, the open is the midpoint of the previous bodies. So that's stuck there. So it's not the actual open for the week, but it's the open of that body. The close is an average of the actual high, low, open, and close, the four prices for the week for the S&P for SPY. So that can change depending upon what happens throughout the rest of this week. This is only one day, so that can move up higher or lower depending upon what we do. So if we do move up closer to this 270 area, then again we'll end up with another small body. Of course, 271.29 is the open. So if I go back to the intraday chart and I change this here to 271.29, there's the midpoint right there, the open. So we'd have to get above that for there to be a long upper shadow, or any kind of upper shadow, excuse me. So that's a long ways away. Now keep in mind we were just there Thursday morning, so it's not that far away considering where volatility is right now. You can see the midpoint of the charts right around that area too. The high point for last week was actually the high point for the 4-week range. So again, it kind of shows how volatile things are when the high point and the low point have occurred in the last 5 trading days, and they are more than 20 points away. They're almost it's almost a 1% gap here. 10% gap between the open and the high and the low that occurred within a week, about within a week. So that kind of shows again how up and down we can be. And you see when I look at the volume for today, let's go to this chart here and look at the volume. The volume at 151 million, again less than what we saw the last few days. So 151 million. The trading range today, no gap there because we filled in. So the trading range at 6.5 points. That's also coming down from what we have been seeing. So 6.5 points is a little bit more than 1%, but it's not 2%. Right. So we're not breaking up above that key 2% level here. And then you can see the volume at 151 million. Kind of starting to come back into the chart's range here, and of course they're all rising. That's bearish. They need to start falling, so you need to start seeing volume coming in below 115 million with the trading ranges coming below 5 points, preferably down to this 2.5 points or less for us to start getting these lines to come down too. Finally, volatility, another sign that we've been so volatile. We got back up to extreme ranges again on an intraday basis, obviously not closing above there. You can see another relatively long upper shadow again today. Again, long upper shadows and volatility are reversal signs just as much as long lower shadows on price are for the S&P, and closing below the extreme levels is a positive sign for volatility, that we're still in this volatility moderation, and still gives you plenty of decent opportunity for option selling. If that's with what we teach in our Wednesday morning options inventory class, that's kind of the basis for that class, is we take advantage of higher volatility. That's why this has been such a good couple of months for that class in terms of our class portfolio performance, because of how high volatility has been this whole time. So to summarize, we had a pretty deep low point coming out of the weekend here. A lot of it Brexit related. We've had a lot of weakness that are really headline driven, but not necessarily like fundamental driven. It's all sentiment based on expectations coming from the headlines. But nothing fundamentally has changed in terms of the economy, in terms of any kind of recession indicators developing. In fact, leading indicators still strong year-over-year numbers, well above 0%, which typically falls below 0% prior to recession levels. So, that being said, when you get a lot of headline-driven, high fear level, sentiment driving the markets, you tend to get a lot of long lower shadows, because it's the closing price that matters the most, not the morning's prices. So today the Bulls won the game, even if the Bears won the first quarter of the game. So what does that mean? Again, those are typically reversal type patterns. Especially with volatility showing the long upper shadows. Are we going to start to hammer out a low point here over the last few days? And start to move things around to the upside. Again, that's the expectation until we break 2600 or until we break 2800. A lot of the ups and downs are simply just noise, and they're big ups and downs because of where volatility is. But the expectations still from a long-term perspective are to generate that next intermediate run. And we've seen very similar patterns on the market forecast indicator now that we've seen earlier this year when we did generate that multiple intermediate rally long-term run. So that's what we're looking for. What do you think? Do you agree with that or disagree with that? Click that poll that's popping out in the top right corner of your screen. Let me know whether you agree or disagree. If you click disagree, scroll to the bottom in the comment section and let me know what you're thinking or what you're seeing. More importantly, what you're seeing. Of course, everybody has an opinion on what they think the market should be doing or what they want it to do. But let me know what you're seeing that would suggest that we should expect something different than what we've summarized with our Outlook video here today. All right, if you take a look at what's driving the price action today, at the beginning of the day, it was risk off, right? The dollar was up and long-term bonds was up. The dollar stayed strong. A lot of that is more of what's going on overseas in Europe with protests in France and Brexit vote in the UK. It's really cast this big shadow over risk appetite in Europe, right? And of course, risk appetite in China is still clouded by the trade wars, fears of trade wars between China and the U.S. So that's really propped the dollar up today. And then, of course, bonds rallying too. But really, from that low point here, from about 9 o'clock on, the bonds actually fell, and the dollar stayed up a little bit and actually rallied a little bit more. But you can see how much stocks went up. The S&P 500 rallied. Small cap stocks rallied, not as much. Developed markets rallied a little bit too. Again, not as much because they're the ones that really drag things down. And then you can also see emerging markets rallied up as well. Again, lagging behind U.S. stocks. Looking at preferred stocks and high yield bonds, they also finished up higher, even with a sharp decline in crude oil. That, of course, weighed down emerging markets. They have a stronger link to crude oil. But you can see that was the big loser on the day. In fact, it was the biggest loser on the day, with commodity prices in general falling, MLPs falling. They kind of get dragged down by crude oil. Is a big component in those two asset classes. There's your international stocks. Real estate struggling today. Look at growth stocks up with value stocks down. So it's an interesting rotation on a day that we had such a intraday drawdown. You can also see bonds up, the dollar up. So this is not the typical quartet of outperformers that you see. Growth stocks the dollar, long-term bonds, and investment-grade bonds, right? All outpacing the S&P as a whole. Not your typical patterns that you see, and you can see some of these others with smaller losses. IWM, you can see gold outpacing crude oil, and you can also see small cap stocks outpacing mid cap stocks. That's really where your weakness was. Not quite in the small cap area as much as in the more mid cap area. And of course, in the real estate, dividend stocks with a small loss, lagging behind preferreds, as well as corporate bonds, both investment grade and high yield. One thing I did want to point out, this came out yesterday, another interesting data set. The historical drawdown for the S&P 500 in any given calendar year is 13%. That's the median drawdown. Of course, there's been a lot bigger numbers during the Great Depression, and some smaller numbers. But on average, you can see some smaller numbers in 2017, especially historically small. But look at 2018 relative to 2016, 2015. A couple weak years. 2016, remember, that was at the very beginning of the year. Last time we saw death crosses were in those 2 calendar years. And then, of course, we know the rest of 2016, 2017 were just great, outstanding years for the markets. And you can see some of these other years. Here's the years where the Fed was raising interest rates, 04 to 06, and the drawdowns we had there, with the drawdown in 07 coming before the Great Recession of a 50% drawdown in 2008. The stock market peaked there in 2007. So a 10% drawdown is actually average for the S&P. Again, I think a lot of our expectations for the stock market are based on this historically low volatility year in 2017, and we imagine that's how it should always be. But the reality is stocks are a lot more volatile than that, and we should be used to it. Not a lot on the economic calendar today. We do have a big week coming up. PPI and CPI on Tuesday and Wednesday will give us an idea of inflation expectations, import and export prices as well. You also see retail sales at the end of the week with industrial production. With industrial production and business inventories coming out, those are GDP numbers. So we'll get a new update on GDP estimates for Q4. Here you can see the expectations for a rate hike for March has dropped below 20% now. Well, right about at 20%, but below 20% for the 250, 275 mark. Again, just to show you what that looks like in the historical chart here. There's 20%, so 250, 275 now has dropped below that line. Hasn't been below this line since last June, so it's been 6 months that the March rate hike odds were below 20%. And so, again, that kind of gives you an idea of how dovish the market's getting. The Fed's widely expected to raise rates in December. There's still roughly about a 75% chance of that happening, even with a little bit of a drawback. But you can see how the market now, and the market hasn't, the Fed has not gone against the market's expectations in a long, long time. So more than likely we're still going to get that rate hike in December. It's March where now it's getting a lot less likely. Unless things change dramatically here, it's getting a lot less likely that we'll get any more rate hikes, at least at the beginning of the year following December the 19th. If you take a look at how foreign markets performed today, S&P 500, there's a few here that haven't updated, but the S&P 500 among all the rest of these was your best performing international market, and you can even large caps and small caps. On the other end of the spectrum, India is dropping sharply below its moving average. Brazil also dropping sharply, you can see, but it's had such a really good game for the last three months. Russia also falling a little bit here. UK, of course, you know why, at its 3-month low points. France also at its 3-month low. Germany forming an oversold cluster again. And then you can see Italy close to its 3 months. So, these developed markets still struggling. Japan also included in that with some weakness in Italy. And China, though. China is well off of its 3-month lows. So not as bad as you see in some of these other Chinese proxy areas, Japan and Korea specifically, as they kind of tend to match what's going on in the world's second largest economy. So, a good day, U.S. outperforming everybody, but showing similar patterns to what you're seeing across the board, but especially the weakness in those developed areas. One of the reasons why in our portfolio management class that we are underweight that developed market area internationally, according to our benchmark, because there's just a lot of weakness now. I actually see more strength coming in emerging markets sooner than I see them coming in the developed markets on an international basis. Okay, let's look at how the sectors are performing. I did tweet out earlier today too this image. When we were down, when the market itself was down 1 2/3%, the top performing sectors at the time was technology and communication services. So those are not areas that you typically expect to be top performers on a large drawdown on a day. In fact, they almost got down to 2% at the low of the day. You can see energy and financials really were your two biggest losers that dragged us down so much. Everything else kind of matching the market. But you see those two with really good gains, not only compared to the market, but also compared to safe havens, XLP and XLU. Well, by the end of the day, you can see that they were your best performing asset classes. So there's the S&P, really strong gains in those, healthcare as well, materials, industrials. At the end of the other end of the spectrum, your only two biggest losers were financials and energy, and they really lagged behind when everything else rallied. Those are your two biggest winners. Those are your two biggest losers. And we'll see, they weighed on the market today, but we're not enough. Again, that's another sign that, when we were really selling off and those two were the two sellers and not these other higher beta names, and they were actually outperforming, is another one of those signs that the selling that we had at the end of it that was breaking support, right, was going to be short-lived. Remember, when you break support, it's one thing to break support on the intraday basis. It's another thing to break support on the closing basis. Of course, the latter is far more important. But take that another step further. It's one thing to break support on a one-day basis versus breaking support multiple days, right? And where it holds, because you can break support 1, maybe 2 days, and then get right back through that level on the upside, and there's your fake out. That's about as bullish of a pattern as you can have when you have those fake out support breakdowns. So when you break support on a one-day basis, not just a one-day event, you have to make sure that one, first of all, it has to be on a closing basis, and second of all, you have to make sure it's not a one-day phenomenon that's just trapping the bears in. The people who are looking at that support level, the same level that everybody is, looking to short when you go through it, only to have to cover as soon as we get right back up above it on a fake-out type scenario. One area in the industrial sector that really did well today was the aerospace defense industry. You can see one of those stocks here, Lockheed Martin at 4.5%, making its way above its 8 and 17-day moving averages. As all three lines starting to converge, you can see a similar pattern on Northrop Grumman, finishing above its moving average today with a good spike in volume there. Unfortunately, Northrop Grumman doesn't have the options volume to be able to make a trade, but you can see a very similar pattern on Lockheed. So we'll take a look at this one a little bit more in depth here. You can see really close to 3 green arrows, not quite that third with a spike in volume. Really close to that same pattern that you see. Now these stocks have really been beaten up. So here's the long-term chart for Northrop Grumman. You got the death cross, the long lower shadow, still holding for support on the closing basis, trying to bounce off of a very bearish momentum here on a long-term level. You take a look at its market forecast chart here, and you can see the intermediate line turning back up with short-term sentiment jumping into the upper half of the chart, and then finally some of these other charts you'll see here. Here's the Bollinger Bands making its way back towards the exponential moving average. There's going to be some resistance in this area. We'll keep our eyes on that, but back in the upper half of the chart after being bearish here with a strong day today. And look at its DMI patterns here, and let's pull up the other DMI indicators down at the bottom, and you can see green arrows close to, the histogram not quite green yet, but turning its way higher, and you can see the blue line rising above 20 for the first time in a while after being down below it for so long with all these divergences setting up, and then the bearish line falling down. So not quite not quite there on the patterns today, as you can see with a long lower shadow like we had today. A lot of bearish and bullish patterns kind of colliding to not really give us a clear signal one way or the other in a lot of stocks, but a strong move in this industry suggests that things may be starting to finally make their way higher. Again, go back to the two-line version. Starting to finally make their way higher for this embattled industry. You can see again the convergence on the lines after the divergence here, and then finally converging with both lines crossing up above their moving averages, even if the stochastics, the moving average, even if we haven't closed above there. Remember, there's different stages to a reversal. The first stage being getting through the 8, 17, and 30-day moving average price. Of course, you need the 8 to get across the 17. You need both lines to get across the 30 to complete that stage. Not quite there yet, but the convergence gives you that, and the volume with the 3 green arrows today gives you that suggestion that that's something we can expect to see, especially with, again, going back to Northrop, considering its place in the industry, and you can see all the the close above all these highs, as well as that piercing line pattern here. So again, kind of playing Lockheed as a a proxy for the industry, as it has the options volume to be able to do that. Still going to be relatively wide spreads. If I sell the 290, buy the 285 put spread, that puts me there's my break even just below that 290 area there. So below today's low point, we have to completely reverse today's move for us to get through. And of course, we'd be willing to take a $124 loss. That gets me down to about, on the purple line as of right now, would be down to about 283.58. So that we'd have to really fall down into this area to take a loss equal to what we're trying to make on this trade. Lots of volume in this area trying to hammer out this low around 290. Both times we closed below it, we came right back up through it. Took a couple of days this go around, considering the weakness in the market the past couple of days, but the strength in the market led in this particular case by this particular industry. Okay, that wraps us up for today. Now I want to hear from you. Click that link popping out in the top right corner of your screen to go to our forums, our Market Outlook forum, and on MarketScholars.com. Any questions you have for me, any comments you have about today's video, any questions you have about something I didn't cover in tonight's video that relates to what we talk about, feel free to post there in the forums. Remember, you have to subscribe, but you can do that for free, as I showed you earlier in the video. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, click the thumbs up icon, and comment on anything that stood out to you. Follow me on Twitter for more content like this throughout the day, and join our community on Facebook that we've created, as well as subscribe to our MarketScholars.com site. Again, have a great rest of your night, everybody, and we'll see you all tomorrow.